Hey everyone, welcome to my channel. I'm Doris. I'm here to share with you about my stock account update. Today, I've earned $996 in my stock account. The market focused on earnings and the Fed policy outlook. With high inflation, BlackRock strategists suggest abandoning its 60-40 portfolio. So let's first take a look at my account. Right now, the net PL of my account is a gain of 1.35%. Including the post-market, I've earned $988. Right now, the net asset of my account is $74,051.82. Today, United States natural gas showed a significant rebound of more than 3% to $7.35. Today, on the other hand, the VIX Pro share made a loss of 1.05% to 3.77, and the SQQQ and the SPXU both showed a slight gain. Today, the market closed mixed. Dow Jones Industrial Average closed down 0.03%, Nasdaq Composite closed down 0.04%, and S&P 500 closed up 0.09%. Today, the internet content continued to show a loss of 1.07%. On the other hand, aerospace and the banking industries showed a slight gain of less than 1%. U.S. stock investors reported the latest batch of earnings result on Tuesday. Bank of America announced the first quarter revenue and earnings both exceeded the expectations. Johnson & Johnson beat the expectations and raised its guidance for 2023. Goldman's results dampened optimism. Goldman Sachs reported weaker first quarter revenue, dragged down by results from its market consumer lending platform. Healthcare stock Walgreens, Boots, and United Health, the group dragged down the Dow Jones Industrial Average Index. The S&P 500 companies, the 30 S&P 500 companies that reported their results so far, 90% beat earnings per share and 73% beat revenue estimates. While these results can show resilience, traders are closely watching the health of companies in a period of continued inflation and interest rate hikes, particularly in the wake of industry-wide turmoil after the two bank failures last month. Investors have warned that earnings expectations have fallen low, so it is not a matter for markets to focus to the Fed's continued tightening and the risk of a potential recession. Ed Moya, senior market analyst at Oanda, said, "The sentiment today is concerned about profitability, which may be a little excessive this quarter, but concerns about Fed tightening will not go away anytime soon." Yardeni researchers at Yardeni said, "Since the beginning of last year, there have been a lot of pessimism about the economic and financial outlook." Yardeni added, "As I said, I think we're in a recession. We've been in a recession since last year, but it was a rolling recession. It was constantly rolling in different industries, and in short, it did not cause a recession across the economy." CE's Fed Watch Tool says that market has a 25 basis point rate hike chance in May. Fed will meet on May 2nd to 3rd, and Fed officials will enter a silent period on April 22nd. St. Louis Fed President James Bullard has called for a continued interest rate hikes to fight inflation. He said on Tuesday that there was no significant progress in the U.S. inflation, meaning interest rates need to keep rising. He said the 5.50 to 5.75% policy rate range was restrictive enough to remain unchanged at a peak for longer until inflation is under control. While policymakers watch this situation closely, with the risk of widespread problems from the bank pressures appear to have been reduced, Mr. Bullard said. Mr. Bullard said the Fed should continue to raise interest rates, given recent data showing continued inflation and the overall economy appeared expected to continue growing, although this on the slow. Bullard disputed the idea of a banking crisis or recession in the near future, or two crises coming together, saying Wall Street strongly agrees with the idea that there will be a recession in 6 months, but that is not the real way to interpret economic expansion. The labor market seems very, very strong. The conventional wisdom is that if you have a strong labor market, it'll drive strong consumption. that is a big part of the economy. Now it seems inappropriate to predict the recession in the second half of 2023. Barlow also suggests that if the collapse of two American banks last month could trigger a crisis, it was likely to appear on the indicators such as St. Louis Fed Financial Stress Index, but the measure quickly returned to normal levels. For now, it does not seem very much is happening. Atlanta Federal Reserve Bank President Raphael Bostic said on Tuesday that he expects the Fed to raise the interest rates by another 25 basis points before keeping rates unchanged for a considerable time. Mr. Bostic said, with another immediate action, we can stay tight and see how much monetary policy passes through the economy and understands how much inflation goes back to our target. Richmond Fed President Alexander Barkin said on Monday that he wanted to see more evidence of inflation slowing down to the 2% target. On Tuesday's economic data front, U.S. housing starts in March grew at 1.42 million units annually, compared with 1.4 million units expected and 1.45 million units previously. The total number of U.S. construction permits in March was 1.413 million, compared with 1.455 million expected, compared to 1.524 million previously. In overseas news on Tuesday, China's GDP grows 4.5% in the first quarter, the highest in a year and above 4% expectations. With high inflation, BlackRock strategists suggest abandoning its 60-40 portfolio. BlackRock strategists will ditch a 60-40 portfolio for public and private investment and tactical bond holdings to weather the high-rate environment. According to Tuesday's report, strategists at BlackRock Investment Institute recommend breaking the traditional asset allocation cage from broad allocation to public stocks and bonds. These old assumptions fail to reflect the new situation we are in. Major central banks are raising interest rates to levels where economy is in recession, or to try lower inflation, strategists said. After falling nearly 17% in 2022, its biggest annual decline in a decade, the Bloomberg U.S. 60-40 portfolio index has risen 6.3% this year. BlackRock strategists, however, caution that this does not mean to repeat the continued rally of the whole portfolio since the early 1980s. The strategists recommend looking at specific equity sectors, such as energy or healthcare, and choosing companies with strong cash flows and resilient supply chains that can withstand a recession. We believe in new days to build our portfolios, they said. The strategist's perspective needs to be more refined for across sectors and within private markets to help build more resilient portfolios in the new landscape, they said. The strategist said investors should reflect on fixed income allocation because the fixed income returns are increasingly related to stock performance and can no longer act as a portfolio ballast as in the past. With yields attractive and above target price pressures likely to continue, they prefer a tactical allocation of inflation-linked and short-term bonds. We expect inflation rate to remain high as the Fed seems to curb viscous inflation. We don't think the Fed will rescue the market by cutting interest rates or returning to a historically low interest rate environment. That's all I have today. Thank you for listening. Don't forget to subscribe and like. See you next episode.